Welcome back to the final episode of the Short Put Masterclass. My name is Stephen Cox. I'm the CEO of Share Navigator and I'm a full-time options and futures trader. In the previous 5 episodes, we've used the S&P 500 ETF SPY as an example of how to create a statistical edge by selling put options and generating trades that deliver a probability of a success of over 92%. We've discussed the trade mechanics, how to establish break even, maximum profit, maximum loss. We've showed you how to place the trade on an online broker, and we've discussed the importance of the Greeks and showed you through the online broker how to establish your profit and loss tables as to what your potential outcomes might be. Now, placing the trade is only half the battle. Managing it is even more important, and that's what we're going to focus on today. Okay, so let's talk about trade management when things go well in the trade. And again, it's assuming this is a return-based strategy. So if you're applying this to an individual stock, not an ETF, which we do not recommend, by the way, as we've previously stated, take profits of 50%. So for example, if you collected $200 in premium, buy yourself out of the contract when the premium reduces to $100, which would leave you with a $100 profit. If applying to an ETF like SPY, which we do recommend, it depends on your outlook for SPY and where SPY is trading at. But as a general rule of thumb, close out when it's in 75% profit and then open a new contract for the following month if appropriate. This simply involves buying back the short put to close out the position. And we're going to show you how to do that now. So here's an example of a trade we did previously on SPY. And this is actually one of our real life trades where we sold the $640 put option. But this is for our November expiry, and this expires in about 18 days' time. So we're going to talk you through each of the sections here. So looking at the bottom window here, first of all, we'll start on the left-hand side. You can see that the current market value of this short put position is $147.50. That means that potentially we could make another $147.50 in profit. You can see underneath that our position is -1. The average price is what we took in when we opened up the position. And the cost basis is simply the average price multiplied by the contract number multiplied by 100, which is we took in $499. On the top right hand side, you can see the daily P&L. So today we're up another 589 on the position. Our total return is 70.2%. In other words, we've made 70.2% of our maximum profit on this trade. And you can see your unrealized P&L is $350. So we've made so far today, since we've put this trade on, $350 in premium. So again, SPY hasn't done a hell of a lot since we put this trade on, but this is again the benefit of time decay, which we keep telling you about, and another high probability trade. So we've a number of choices here. We could leave this trade on if we wanted till expiry and let the $147 run out, and then that would go over to our P&L side, and our unrealized P&L would go up by another $147. Or we could close this out and maybe open up another one for a later expiry like December. Closing the position is really simple. You can do it from this screen here. You can see the 3 dots on the right hand side that I've highlighted. Simply click on the 3 dots and an option will open up and you click on close. And this is the screen you will see. So we'll talk you through each section on the screen. On the top of the screen, you can see order ticket, and you can see that it just describes the position. So we know it's the SPY November 21st $640 put option. It gives you the bid and ask price and the last price. And then you can see there's buy, sell, and close, and it's highlighted close. And then you can enter the trade parameters. The quantity will default to the amount of contracts you have when you click on close. So that's why we always recommend clicking on close. So if you had 5 contracts open, for example, the quantity would automatically populate with 5. You can enter in your limit price, or you can go on market here, click on preview then, and we're just going to show you what the preview window looks like. So the preview window looks like this, but I want to focus all your attention on the bottom part. Look what happens your margin. So what it's saying here is our initial margin is 19,408. After the trade is completed, which is closing it out, we reduce our margin by 9,500, leaving 9,800 because of other positions we have on in our account. So closing down the trade reduces our margin. And that's it. You click on submit buy order, you'll close out and you'll have made your profit. So it's really important now to have a management system in place for when the trade starts moving against you. So first of all, define your criteria as to when you're going to take the appropriate action. So with our SPY short $640 put, our rules are very simple. If the share price gets within 1% of the strike price, we start taking action. So the share price of SPY is currently at 684. If it fell to 646, which is 5% lower than where we are now, then we would start to take action on the trade. What action would we take? Well, this would depend on our outlook. If we believe that this is just a short-term correction, we're still happy, we will roll out and down, and we're going to show you how to do that now. But if we fear this might be the start of a big sell-off, we would close out the trade and take the loss. Sometimes the best trades you do are the ones where you just take the loss early. So how do you roll out and down? Well, this involves two trades. Trade number one is you buy back your existing short puts, so you buy it back to close it out. And trade number two then is you sell another put option out for a later expiry, but roll the strike prices down, which creates a lower break-even price. And this can be normally done at a credit as long as you close down trade number one before it goes in the money. We're going to show you now with an example. So let's go back to our original trade, our December 19th short 640 put on SPY. You can see at the moment, let's pretend we wanted to close it out and roll it out and down. We could close that out now and we would be paying $4.92 per share or $492 per contract. Now look at the expiries for the January 16th SPY options, and we can see that if we sold now the 615 put, we would actually take in $512 per contract. So let's do the math on that. Our original short put expiring in December, we originally received $480 in premium. Now we're doing the rollout. So we bought back the existing put for $492. And trade number two, you can see we can extend the time frame out to January and roll down the strike to the 615 put, and we took in 512. That gives us a total credit of $500. Our new position then is a short SPY January 16th, $615 put option. But our new break-even price is $610, which is $74 lower than our original price SPY was trading at, 11%. And remember, this only works as a credit when you apply it before the original put goes in the money. Hence the strict trade rules. You need to develop those and stick to them. So it's important to talk about the assignment risk with the short put strategy. So if the option gets to expiry and SPY is 1 cent in the money, then you will automatically be assigned your 100 shares. However, you can be assigned before expiry, but this only usually happens if there's a big dive and rapid drop in the share price and it's in somebody else's interest to execute their right. And by the way, this is done on an auction basis in an options exchange. So there's like a lottery that goes on for all the short put option contracts. And if somebody wants to exercise their right, then there's a lottery and it might be yours. For cash secured puts, this is not a problem because you're happy to own the shares anyway. For return based strategies, this could be an issue, and you may need to sell your position when you get assigned. So, our short put conclusion, hands down, this is my favorite strategy. It's an excellent high probability strategy when it's done well on ETFs like SPY. It's best applied when implied volatility is high. Sell out of the money puts with delta of around minus 0.2 or lower, with expiries 30 to 60 days, where you get to leverage theta. Close winners at 75% in your ETFs to manage your gamma and vega risk. And risk management, trades do go wrong, even though they're high probability. Sometimes you have COVID events, for example. You've got to learn how to take action quickly. And our rule of thumb is when SPY gets within 1% of our strike price, we roll out and down. And please stay disciplined. Discipline will help you make consistent profits. And remember, we have a 93% success rate. If you follow the rules, you will be successful with this strategy. Okay, that's it for the short put option strategy. If you enjoyed the content and you want us to provide more content and other option trading strategies, please share, like, and subscribe. It really does help in us continuing making this content. And finally, if you would like to have a free one-to-one masterclass with me on option trading, please go to our website, sharenavigator.ie. And on the pop-up window, just schedule a meeting with me. It's totally free and we can work with you on a one-to-one basis. Thanks and bye for now.